Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about what to look for when hiring a financial advisor. I'm not someone who thinks that every human being needs to hire a professional for help with their financial management, but I do think that to do the process justice, it takes some time and energy and effort and attention if you're going to get yourself to the best financial destination for you and your family. And for that reason, financial professionals might be a good option for a lot of people out there. That being said, it's pretty confusing when trying to decide how to find one, where to look, what to look for, what kind of skills and experience and credentials, what kind of service model am I looking for. So today on the show, I wanted to walk through the criteria that I think are important for people to consider when hiring a financial professional for help with their financial stuff. We go through what that criteria is, a couple different service models, and how to look up the track record of an advisor, including their disciplinary history if you're considering hiring someone. I hope this is helpful, and I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today on the show, I would like to talk about a subject that I believe we've covered maybe a couple of years ago, but it's been a while since we've discussed it. And that's what to look for in a financial professional. If you're someone out there who's looking for some kind of financial help, there are all kinds of practitioners out there who might be able to help you, but different financial professionals do different things. They work in different ways. They're compensated in different ways. They have different backgrounds and skills and experience. And the landscape is just kind of confusing for the average consumer. And we as practitioners in the financial community know this, and a lot of us are desperately trying to make it more transparent and easier to understand for everyone, but that's just kind of the way it is at this point. So I wanted to spend today's episode just talking through what you should look for in a financial professional if you're somebody out there who's looking for help. There are a lot of factors here. There is no perfect financial professional, except for myself, of course. Nobody's perfect, and everybody has a slightly different background. I'm not someone who thinks that every single person on earth needs a financial professional, needs to hire a professional to reach the best destination for them. My take on all this is that handling your own finances can be somewhat complex if you make it complex, but it doesn't need to be. And the stuff that you need to know to do it properly is readily available on the internet for free to everybody. And I think anybody who's, capable of driving a car can probably figure it out on their own. That being said, it takes a lot of time and effort to understand how all these things work together. If you're going to save a little bit for your own retirement, put some money into an IRA or a Roth IRA or start a 401k, or maybe pursue some strategy to pay a little bit less on your taxes or organize your cash flow and pay off your debts. Seems like there are a lot of different moving pieces with that. None of them are overly complex, but it takes a little while to learn how all the pieces fit together. Because at the end of the day, everybody has a similar set of financial stuff that they have to deal with. You probably have some income coming into your household. You probably have to pay some tax on that. Figuring out how to pay a little less tax is beneficial to you. You probably need some kind of insurance to manage your risks of dying prematurely if you have kids or other people depending on your income, or maybe becoming disabled and not being able to earn an income. You probably want to organize your estate at some point to make sure that your stuff passes to the people you want in the most efficient manner possible. You probably want to make sure that you're saving enough and you're on the right track to accomplish whatever your long-term goals and objectives are. And, if you're on that track and you're saving in some kind of retirement or investment portfolio, you want to make sure that your investments are set up properly to support your long-term benefit and long-term investment growth. And there's just a lot to it when you put all that stuff together. Again, none of it is that terribly complex, but there's just a lot to learn. And unfortunately, the landscape changes a little bit over time. The investment markets evolve and change as the market structure changes and new rules are implemented. The tax code changes every couple of years when the White House flips from blue to red to blue to red, as does um, the Senate and the House of Representatives, of course. And so there's just this moving landscape, and it takes a deliberate effort, I think, to organize all your resources in a way that are aligned together, propelling you toward wherever it is that you want to go. So if you're someone who's ambitious and interested in this and has the time and energy to devote to learning all this stuff and doing it on your own, then I'm of the opinion that that's what you ought to do. There are a lot of convenience factors when you hire a professional. Number one, if all of that's true, if you're someone who's self-directed and likes this stuff and spends time learning and understanding all the nuances, we've worked with a lot of people who fit that um, classification or fit that description in the past. But at the end of the day, a lot of them still don't have direction over what it is they want to do financially. They need some help articulating those into measurable objectives, which is a benefit of hiring a professional. Now, if you're someone who's not interested in that, or maybe you don't have the time to do that, I like to use the example of, if you're an attorney and your going rate is, excuse me, I'm a little bit stuffed up today. The allergy season here in Sacramento is brutal this year, and it's got got me congested. If you're an attorney who bills at $500 an hour, then if it takes you 20 hours a year to manage your finances, then you're probably better off working as an attorney and billing 20 billable hours for $10,000. Because if you can hire a professional to do that same management for you for less than $10,000, you're economically better off. And from a professional standpoint, I have a passion about this. I do my own finances, but I have the benefit of doing this as my day job. And so we learn all the nooks and crannies of the financial system and how best to arrange everything, because I do this all day, every day. And so it's more efficient. I would argue that it's probably a lot more efficient for um, a professional who does it every single day to manage that attorney's finances than it is for the attorney to do it themselves and try to synthesize a whole bunch of new information that they are not as familiar with because they were off studying constitutional law over the previous weeks, whereas the professional is digging into the tax code and the investments and all of the above. So that's a starting foundation for today. What I wanted to cover is if you're someone who thinks that you might need help, either for a little while or for a project or for in an ongoing kind of relationship, there are a lot of financial professionals out there. There are more or less 300,000 people in the U.S. today who are licensed in some way, shape, or form to help you financially. And people call themselves all sorts of things these days: financial advisors, financial planners, wealth managers, investment advisors. There's a whole litany of terms that professionals like to use. But at the end of the day, pretty much what everybody's trying to do is help you do the best you can with what you have. Some people are more narrow in scope. They'll only focus on investments or only focus on insurance or something else. Some people are more comprehensive and broader in scope. That's how our firm is set up. But there are a couple basic things that I think you want to look for first. Number one, I think that if you're going to hire someone for help with your stuff, and I'll let you fill in that description of what your stuff is on your own, then you probably want someone who is legally compelled to act in your best interests first. And what that means is I'm alluding to the term fiduciary. Fiduciary is a term that pretty much everybody has heard of, but I think few people truly understand the real meaning of it. For years, financial advice has grown out of the insurance and the brokerage industries. And so in the 1950s, a life insurance salesman might walk around the neighborhood door to door trying to sell life insurance policies, and that was probably pretty effective back then. And you might, buy a life insurance policy from this person, but it's pretty clear that their interests are in selling you a policy. They're not delivering you objective financial advice. They're trying to sell you a product. On the brokerage side, investment banks exist to raise capital for companies. And so if you're a large company and you're growing and you want to raise capital, you might want to issue debt securities, or you might want to issue an IPO and sell stock out on the public markets to raise cash and fuel your further growth. Whatever it is, an investment bank helps you do that. And stock brokers are historically employees of an investment bank. And so if you're, a manufacturing company and you want to go public and raise a bunch of money so that you can continue growing, you approach the investment bank, or maybe the investment bank approached you with this. And they say, you can sell some of your equity on the open market. It'll raise the value. It'll be really great for you as the owner. The investment bank gives you the cash, and then they turn around and sell the stock in the open market. And the stockbrokers are historically the party that takes the shares that the investment bank has just purchased and turns around and sells them out into the open market. And over the last 7 decades, that role has evolved to become less about the brokerage and more about the advice, right? If you think back to the 80s and 90s, when you had big trading desks on Wall Street, they were calling every phone number in the United States trying to sell you on some hot new investment idea. That was because they had shares in their inventory they were trying to sell. Well, now we don't make investment decisions based on the hot stock tip of the week that some broker was trying to sell you. You go online to your investment account and you purchase shares, and they even trade commission free these days. So the model has changed. But the employee for the investment bank, in order to figure out, because the model has changed, that employee's had to figure out how to add value to the everyday consumer. And that's evolved from being the mechanism to obtain shares of stock to provide more comprehensive planning and advice. Because today, the execution of brokerage, the action of going into an account, purchasing a share of Apple stock or anything else, is a total commodity. You can do it for free on almost any brokerage platform. And the value add is having a relationship with the representative of one of these companies who knows you and your intentions and hopefully your family and what you're trying to do with your resources, and can advise you on how best to structure things to reach the best destination long term. So that's a really long-winded way of saying that stockbrokers never had to be fiduciaries, because their role, their job was to take shares that an investment bank just purchased from a company going public and sell them out into the open market. Their job was as a representative of the brokerage firm, not as your fiduciary. So over the years, this role of financial professional has evolved quite a bit. And now, if you're someone who's looking for help with your stuff, you're probably looking for some kind of advice about that stuff and some comprehensive process that'll help take a look at all your assets and liabilities and income and expenses and needs and comfort levels and all that stuff, and advise you on how to structure all of it. And so historically, advisors who work, I'm reluctant to use the word advisor, I just let it slip in there. People who worked at brokerage firms started to call themselves advisors, but were actually representatives of the brokerage firm. Now let's contrast that. You have employees of a brokerage firm, then you have other employees of a firm called a registered investment advisory firm. And the brokerage industry came from the capital raising process, like I described. But back in the investment, I think it was the Investment Company Act of 42, if my memory, 1942, if my memory serves, it was the piece of legislation that enabled mutual fund companies to form. And if you're considered under that act to be a registered investment advisor, if that's the firm that your professional is working under, they have a fiduciary obligation to act in your best interest at all times by virtue of being organized pursuant to the Investment Company Act of 1942. If you're a representative of a brokerage firm and not under that registered investment advisory or RIA, and I promise not to use acronyms today, if you're an employee under the brokerage firm, you have no fiduciary obligation. You have to be under a registered investment advisory firm to have that fiduciary responsibility. So that brings us to today. If you're looking for help with your stuff, you should probably look for a fiduciary who is legally compelled to put your interests before theirs. So about 10, 15 years ago, there was this big push for people who were calling themselves financial advisors but working in a brokerage firm to reorganize and work at a registered investment advisory firm. And there's been this big exodus from the brokerage industry toward the registered investment advisory industry for that exact reason. And I'm not insinuating that the people under the brokerage umbrella were necessarily bad. That's just how the industry evolved. There are great people under all of these different models. But the portion of those 300,000 professionals working in a registered investment advisory firm has grown big time over the last decade because advisors realized that was a better model for their clients. They could add more value working under that structure. So that's where they went. They can take on more clients and it works better for everybody. So it was a natural progression there. So these days, if you're looking for help with your stuff, I know I keep circling back to that phrase, but if you're looking for help with your stuff, you probably want a fiduciary. And what that means is that the person delivering the advice is legally compelled to put your interests in front of theirs. It'll be in writing. If you sign an agreement with a professional, their status as a fiduciary should be in that agreement that you both sign. And realistically, what that means is if you ever come to a point in the engagement where you think they've made a recommendation that puts their interests before yours, you have legal recourse. You can either take them to court or you can take them to arbitration. Financial industry, most of these agreements are settled by arbitration. If you have an engagement with a brokerage firm that has no fiduciary responsibility, and they put their interests before yours, you have no legal recourse against that. That's just part of the game. You walk into the mattress shop, you have to understand that they're trying to sell you a mattress. They're not trying to put you in the best mattress for you. They're trying to sell you something. And registered investment advisory firms are also trying to sell you something. They're trying to sell you their services, but they're not trying to recommend a product that benefits them before you because there's a legal requirement for them not to. So characteristic number one, if you're looking for help with your stuff, probably want to look for a fiduciary. Point number two, I'm not totally rigid on, but it's the mechanism of compensation. Now, I'm going to get into service model here in just a minute too, but there's this industry term called fee only. And back to the 1950s, the brokerage, the insurance days, the industry really came out of a commission model and a commission world, where if you're buying a mutual fund from somebody or you're buying an insurance policy from them, it's understood that there's some financial benefit to them for selling you that product that you might not see directly. If you buy a mutual fund from a representative of American funds, that representative is probably going to be compensated somehow. If you buy a life insurance policy from someone, there's a commission attached to that. That's legally how life insurance has to be sold. And it's not always the most objective way to do business if you're in the business of delivering advice, right? If you go to a financial professional who you're hoping is going to give you recommendations that will help you based on the circumstances, you probably don't want that professional to be compensated based on whether or which option you choose. You might be trying to retire in 5 years, and you go to someone and say, hey, I'm not sure I'm saving enough. I'm not sure my portfolio is set up right. I'm just unsure about a lot of this. And so they might come back to you and say, okay, we've crunched all the numbers. We have 2 options for meeting your objectives, option A and option B. They'll both work. What you don't want is for that professional to be compensated more or less for recommending option A or B. And that's what happens in the mutual fund and the insurance world is you might pay the professional for their advice, but then they might also be collecting some other form of compensation based on how you execute that advice and which option you choose. And I would argue that when you're looking for help with your financial stuff, you probably want someone who's not influenced by that and is going to be objective across the board. There are a lot of shades of gray here. I know phenomenal advisors I think very, very highly of and that are role models of mine that still work in a little bit of where they're influenced by commissions in some way, shape, or form. There's a way to deliver a great service to your clients and still offer insurance products. Our firm is considered fee only where we don't sell insurance directly. And so what that term means is if you're fee only, the firm is only compensated by fees paid directly from clients. That could be a check that you write to the firm. It could be an ACH bank transaction to the firm. It could be a percentage of the assets in your account that the firm deducts out of your account. It's you paying the firm directly. Any of those are considered fee only. What it does not mean is that the firm also collects commissions for selling certain products. And that can be anything. It could be a mutual fund, it could be an insurance product, or a combination of the two. And so being fee only means that 100% of the compensation comes from clients directly. Being fee based means that some of your compensation might come from commissions or other sources. I've heard professionals say in the past that, well, most of my practice is fee only, or 95% of my practice is fee only. That's not what it means. It's kind of like saying 95% of, or it's kind of like saying I'm 95% pregnant right now. It's black or white. It either is or it isn't. If you collect any kind of revenue from sources other than your clients directly, then you are not fee only, you're fee based. And again, there's great advisors that work in that environment, but it's a spectrum. Either either the compensation and revenue comes directly from clients, where you're fee only, or it comes directly from other sources and only other sources where you're commission only. And anything in between those 2 points is called fee based. So I mentioned that this is a point I'm not totally rigid on because I do know great advisors who work in a fee based world. I think it's more important to find someone who's going to be a fiduciary and has the skills and experience and setup and process to give you a lot of confidence that they're going to be able to help you, regardless of whether they're fee-based or fee-only or whatever else. I do think it's really important that they're transparent about the cost in a way that lets you evaluate what you're going to get from the engagement compared to what you need to pay for it. That's something that's been missing from the financial industry for a long time. It's getting more transparent, but I can't tell you how many brokerage account statements I've tried to dissect on behalf of people because they don't know what they're paying their advisor. And it's almost impossible for me to figure it out. And I've been doing it for almost 20 years. So regardless of what kind of professional you decide to go with, whether it's a fee-based or fee-only or commission or whatever, it needs to be totally transparent what the cost is versus what you're getting out of it. Because at the end of the day, a relationship with a professional, whether it's a financial professional or an accountant or a lawyer or anything, for it to make sense for you, you have to be able to accurately compare what am I paying for this service and what's the value that I'm getting. Because if you're getting more in value out of the service than what you're paying for it, then it makes sense to keep going. Back to that attorney, right? If you're making $500 an hour working as an attorney, that's what you like doing and enjoy and have time for, and you can pay someone $5,000 a year to help manage your finances while you go and make $10,000, that's helpful. And if you feel like you're getting more than $5,000 in value out of the engagement, then it makes sense to continue with it. And if you're not, then it makes sense to discontinue. But it should be well articulated. You should feel comfortable and confident with what the cost is and what the benefit's going to be. Now, financial professionals can't quantify exactly what the benefit's going to be, right? You're a lot of it is qualitative, and you have to have a good feeling about their process and their skills and experience, which I'll get into here in a minute to confirm whether the value's there. So it's a little bit touchy-feely in that regard. It's not like I'm going to pay you $5,000 and I'm going to get back $8,000. You have to just have a good feeling that what you're getting is worth more than $5,000. So that brings me to skills and competence. We covered fiduciary, we covered fee only versus fee-based versus commission-based. Now I want to talk a little bit about skills and experience. When you're looking for help with your stuff, I don't think it's a requirement that that person have a PhD in economics or all the credentials under the sun or 25 years of experience. I think it's really important that they have experience solving the problems you're looking for help with, and they speak confidently enough about those problems that it makes you feel comfortable. And this is a really good barometer, by the way. Someone that doesn't have a whole lot of experience solving these problems is not going to be able to articulate how to help you with them with confidence. It's just something that takes reps to develop as a professional. So experience, years under your belt helps there because it gives you an opportunity to have more reps and develop more confidence in these areas. But I wouldn't disqualify somebody super young if they can articulate really well how they're going to help you solve your problem. And that comes down to, yes, years of experience is helpful, but it's not mandatory. I think you do want someone that has, a reasonable amount of mental horsepower, and I don't think it really matters that much whether they went to Harvard or whether they went to Sacramento State, but they better be able to communicate pretty well. And I think you definitely want them to have at least an undergraduate degree. So even though they might not have to have, a whole, a number of decades of experience in order to help you, they have to have a process that's going to give you confidence that they've done this before and they can lead you to the best outcome. And that's another area where their confidence in articulating what that looks like is a good barometer. Because if somebody is struggling to describe what would happen next after you sign on as a client, then that's not a good sign that they have any idea what they're doing. And there are, unfortunately, a fair amount of those 300,000 financial professionals that just don't have a lot of experience and don't quite know what they're doing. So it's a little bit of a qualitative, touchy-feely thing. Confidence in articulating what they do, how they do it, what their process is helpful. Skills and experience credentials are also helpful. If you're looking at what letters behind their name matter, the letters that matter are CFP, Certified Financial Planner. I don't think it's mandatory that the person that, if you're looking for help, the person you hire has that designation, but it's the most common. It's the most widely regarded in the financial planning universe these days, and it's the one that gives you the broadest skill set when you obtain the designation. So it's not the be all end all. If you have some specific need that you're looking for help with, you don't just want to go find any old CFP, because it is a broad base of education, and with a fair amount of depth in it. But if you have some specific need, I think you want to look for specific expertise and experience with that need. CFA is another one. Chartered Financial Analyst is what that stands for. That's not in financial planning focused at all. It's investment focused and portfolio management. I think of those as two separate things. Financial planning in a comprehensive way, cash flow, debt management, tax planning, risk management and insurance, retirement planning, estate planning, investments, all of the above. CFA is only investments, and it is really, really deep in investments. It's the gold standard in the industry for investment credentials. It's one that I have that I'm really proud of, because it's just a beast to obtain. You have to have 4 years of experience and an undergraduate degree, and then you start studying. When I took it, it was only offered once a year. 3 levels of testing that takes a good 4 or 5 months to study for, and you're doing, I think it's probably 1,000 hours of study and preparation for each of those 3 exams. I think that's about what I spent on it, if I'm not mistaken. The first level is given twice a year. The second and third levels were only given once a year. When I took it, I think they've changed the cycle on that a little bit since then. But it's a really tough designation. So if you're considering someone and they have a CFA, it tells you that they definitely know their stuff with regard to investments, but it doesn't really tell you a whole lot about their planning expertise. The CFP is what does that. Other designations that are helpful: CPAs and EAs, so certified public accountants and enrolled agents, clearly very focused on tax and maybe not so much other stuff. Behind that, there are a whole bunch of other designations. Some of them are somewhat challenging to obtain. Others are really easy. I have a couple of them that took me like a week or less to obtain, because there was subject matter that I wanted to sharpen my expertise on, but they were really pretty simple. And someone that has that doesn't immediately tell me that they really know their stuff. Someone that has a CFP and or a CFA, a much higher threshold to obtain those designations, that tells me that their baseline level of expertise is at least a little bit higher. So fiduciary is important. Fee only is relevant, important, but not, in my opinion, a deal breaker if they're not fee only. Skills and experience, very important in the issues that you're looking for help with. Education and professional credentials, also good barometers, but not necessarily a deal breaker if they don't have a specific one you're looking for. Now, that brings us to service models. Advisors work in all in all shapes and sizes. They come from all shapes and sizes. They work in numerous different ways. The biggest thing that I would suggest out of the gate that you think about is whether you're looking for some kind of ongoing relationship or whether you just need a one-time project done. Hey, I'd like a second look at my portfolio. I'd like to pay someone a fee to review what I have and give me some suggestions. Or, hey, we're doing a good job saving, but I want to make sure that I'm still on the right trajectory and can retire at 65. But what you're looking for is a limited scope engagement. That's very, very different than having an ongoing relationship with a professional who knows you, that you have some rapport with, who can be proactive and reach out in times of need. It's a very, very different kind of setup than a one-time project. There's no right or wrong here. In a one-time project, you're looking for limited scope stuff. Usually, that's going to be either for a flat fee or an hourly fee. And so if you're 50 and you think you're doing great saving, but want a second opinion, want to make sure you're still on track to retire at 65, you might reach out to a financial professional for help with that project. They might charge you a flat fee. It might be $2,500 or maybe more than that, $5,000 for a one-time financial plan. Or maybe it's an hourly, $250, $300 an hour, something like that, depending on the skills and experience of the professional. And so you would talk to them about it. You'd map out exactly what you're looking for help with. They would quote you an estimate of how many hours they think that it'll take them to produce it. And then you determine whether or not to continue with the engagement. That's a great setup. It's what a lot of people are looking for. It's what a lot of people need. And there are advisors out there that do that. The benefit of it is that it's the least expensive way to get some kind of professional help. And you can get an objective second opinion at really very little cost in the grand scheme of things. The big downside of doing that and having a one-time kind of engagement as opposed to an ongoing relationship is that if you're working on an hourly basis, that advisor is not going to be proactive on an ongoing basis. And so what I mean by that is we've, and some history here about the firm, I started the firm in 2014. And when you go out on your own for this kind of thing, the first couple of years are really, really rough, like any new business. And you're just trying to get revenue dollars on the door. And so you'll take anybody regardless of what their needs are, is often the tactic. That was my tactic back then. And so we would take on hourly projects. We would take on one-time financial plans. And on an hourly engagement, people would never call. People wouldn't want me to call to be proactive when something was coming up. They would never reach out to me when some issue was coming up. They would only reach out in case of absolute emergency. And that's not a terribly great way to operate with your finances. And so hourly works pretty good if you want a limited scope engagement. But what you don't want is the expectation that a professional in an hourly engagement is going to keep track of you over time and help you as the landscape changes. And what we've moved to over the years is an ongoing model where people pay us a fee for the service. It's open-ended. There's no long-term commitment to working together. But that type of structure enables us to be proactive throughout the year and stay on top of stuff. And when people are considering something, even if it doesn't seem like a big decision now, it might be a big decision. And having a discussion about it before things get really dire is a huge benefit to them long term. So we work on in a system to where we have an ongoing relationship with people. Our clients, by and large, feel really, really comfortable with that because they know us, we know them. We meet throughout the year. We have a service model of stuff we cover throughout the year based on the calendar and make sure that we're staying on top of all of it on an ongoing basis, which enables us to be proactive as opposed to reactive when stuff goes wrong. So again, there's no right or wrong here. There are a lot of advisors out there that'll do limited scope work for a flat fee or for an hourly rate. Works great for some people. We've chosen to go the other route and offer services on an ongoing basis. And most of the people that we run into who are considering services are looking for that kind of thing. Now, there's some selection bias there because we have on our website, threeoakswealth.com, really clear descriptions of what we do and how we do it. So if people are looking for a one-time engagement, usually they're checking out the website first and are not reaching out. But it's one of those things to where if you're on top of your stuff and you want to pay attention to it on your own, and you just might want a second opinion, make sure you're on the right track or get a professional's opinion on something you're considering once, that's a great option. And there are, like I say, there are advisors of all shapes and sizes and experience levels that offer limited scope kind of work. But if you're not sure and aren't interested in staying on top of this stuff on an ongoing basis, periodically throughout the year, every single year, then an ongoing engagement with a professional just makes a lot of sense. Because they're at the end of the day, there's a lot of stuff to sift through. Like I say, the tax codes change over time. Knowing how that impacts you, making sure that you're still going to be on track, is something that a well set up professional should have the ability to offer to you. And there's a lot of value in that. So if in the ongoing bucket model, there's a couple different ways that people will set up their services. Some will charge a flat fee, either monthly or quarterly or annually, for their work that's based on complexity or service tier or some combination of the two. There's also a percentage of assets under management, which is predominant in the industry and aligns, for the most part, aligns your interest with theirs, in the sense that if the value of the accounts goes up, the fee goes up. If the value of accounts goes down, the fee goes down. There are people listening to this that are saying, well, that's not entirely true. What if I come into some money and I'm trying to decide whether to pay off my mortgage? A professional with an assets under management engagement would be incentivized to recommend that we put that money into the portfolio as opposed to paying down debt, putting it against the mortgage. And that's absolutely true. There are conflicts of interest with all of these models, no matter how you slice it up, and some are better than others for your needs. Commissions have a lot of conflicts in them, but there's a time and the place to hire someone who's incentivized by a commission. If you need a term life insurance policy, the party that you're going to buy it from is going to get a commission, and that's a really reasonable thing. So there's no right or wrong here. The important part is that you're able to find a setup that matches your needs, meets you where you are, and gives you a lot of confidence that you're going to get more value out of the engagement than the fee that you're paying. And the barometers here are that if you don't feel good about that, you can't see where the value is before signing on the dotted line, then that's probably not the right fit. And on the other side of the fence, if you can see the value, but you're unclear on what the cost is to you, that's not a good fit either. Or if you're clear on what the cost is and what you think the value that you get out of it is, if you're clear on those things, but you're not totally clear on what happens next after you sign on the dotted line, or what the service model is going to be, or how frequently you'll hear from them, or any of those things that you might have questions about, those aren't good signs either. So when you walk into a financial professional's office for the first time, it's a scary thing. And most of us as practitioners know that this stuff is really confusing. And you probably just have questions about what am I going to get? What am I going to pay for? What does it cost? What should I expect? Right? Those are very basic questions that somebody ought to be able to answer and articulate well. And if they have the background and can speak confidently with regard to how they'll solve your problem and when and why, then there's a chance that could be a really good fit. Now, there's a couple things that I would suggest on top of this, right? So what we've talked about so far are criteria for selecting an advisor, criteria for what model might be the right fit for you. There are also some background check things that make sense to look into. If, for example, if I'm involved in some kind of Ponzi scheme and I defraud a lot of people of money, then there are going to be legal ramifications there, obviously, and I have to report that to a number of different parties. Number one, if I'm ever involved in a Ponzi scheme, then my licenses are going to be revoked immediately. But if it's something less severe than that, my licenses could be suspended, or there might be a history of complaints or something like that. I might lose or be suspended from using a professional credential. And you can look up disciplinary history for all this stuff for anybody you might be considering hiring. The places I would suggest you go to, number one, the IAPD, the Investment Advisors Public Disclosure. If you Google IAPD, it'll take you to this website, and you can search for a firm or an individual and take a look at their disciplinary history. If there have been complaints against them, if there have been legal proceedings at any point in time, they'll show up there. And that's something that you probably want to know about. On the same token, if they have a professional credential like a CFP or CFA, you can verify their standing and disciplinary history with those organizations as well. So certified financial planner is what you Google there. It's the CFP. I can never remember whether it's cfp.net or cfp.org, but you can look up somebody's history with that credential and that credentialing organization in those websites too. And that's worth a check just to cover your bases and make sure everything lines up appropriately. Okay, I think we covered it for today. That's a lot of stuff, but fit is different for everyone. These days, there are a lot of advisors focusing on specific niches, specific problems, specific types of clients. And when you do that, if you're someone who focuses on working with just tech professionals, a lot of advisors do that, then you know the ins and outs of restricted stock units and stock options and the taxation of that better than most other advisors. Because if all your clients have the exact same problem, you can figure out how to solve that problem and increase your depth of expertise a lot easier. But if you're someone who's a generalist that has clients of all shapes and sizes, then it's harder to go into that depth. Our focus here in the firm is to work, we specialize in working with small businesses and small business owners. And that that kind of stuff that demographic goes through is what we're really good at. And that means cash flow management, tax planning, tax management, getting the company benefits and the 401k and the retirement plan stuff set up in a way that matches the business's cash needs with your personal and household cash needs is just something that is pervasive for small business owners and what we spend a lot of time focusing on. So that happens to be our niche, our carve out, our segment. But my suggestion is that, again, if you're looking for help with your stuff, find someone that has specialty and expertise in solving the problems you're looking for help with, charges you a transparent, reasonable fee. They have some experience with this issue you're looking for help with, and have a service model and a process that's a good fit for what you need. Okay, that's it for today. Hope this was helpful to everybody, and I'll talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.